Hello, and welcome back to DoubleLine's Channel 11 News. I'm Ken Shinoda, Portfolio Manager at DoubleLine, and your host today, Thursday, September 24th. Newton's third law of motion is in action this September. For every action, there is always an equal and opposite reaction. Known more commonly as what goes up must come down. High flyers in the equity market like Apple and Tesla are leading the journey back down to earth. On the month, Apple and Tesla are down 15 and 23%, while the broader NASDAQ is down 10%. We won't cry for investors just yet, as the NASDAQ is still up 18% after being up 35% at the highs. The S&P 500 is down around 7%, bringing it barely positive on the year. The outperformance of growth over value finally reversed course after hitting the highest relative outperformance since 1999. The Russell Growth 1000 index is down over 8% this month, while the Russell Value is down 5%. September is turning out to be the worst month for U.S. equities since March Madness earlier this year. With the increase in volatility and negative price action in broader risk markets, U.S. Treasuries continue to be well bid, and longer-term 10-year Treasuries appear to be holding the post-COVID trading range of 50 to 80 basis points. While credit spreads have leaked out a bit, there isn't much panic in the air. For now, the bond market has reverted back to its role of stability in a portfolio. It just has less yield than it used to. I suppose it's not shocking that volatility is on the rise. After all, we have a likely polarized and possibly legally contested election here in the U.S. in just 6 weeks. Looking back over the last 6 months, some of the main drivers that tick markets off their March lows include a large fiscal stimulus package, an extremely accommodative Fed, improving virus data, hopes of a vaccine, and economic data surprising to the upside. Recently, it seems the markets continues to be disappointed on many of these fronts. In Washington, Congress continues to hit an impasse on a second fiscal plan. There was a glimmer of bipartisan hope emerging, but after the tragic passing of Justice Ruth Bader Ginsburg last weekend, there are now worries around a greater divide emerging over Trump's push to elect a new Supreme Court justice prior to the November election. Jerome Powell in the Federal Reserve Bank disappointed some investors with a less dovish than hoped for FOMC meeting earlier this month. Many market participants were looking for an extension or even an increase in asset purchases. Others thought that more aggressive language on inflation targets was warranted, including members of the Fed. After the Wednesday meeting, President of the Chicago Fed, Charles Evans, suggested that once the coronavirus is under better control and unemployment has come down somewhat, the Fed may still need to shift its accommodation into higher gear. That push could take the form of promising to keep interest rates pinned near zero until inflation reaches 2.5%, not the 2% for some time period language that emerged from Jackson Hole. This approach does seem sensible, given that core PCE index, the Fed's preferred gauge of inflation, while measuring above 2.4% a few times in 06 and 07, hasn't remained above that level for a sustained period since the early 90s, almost 30 years ago. On the virus front, there are signs of rising case numbers in a number of key regions, and some governments have moved to reimpose restrictions. Western Europe has been an increasing area of concern, especially Spain and France. Summer tourist spots such as Croatia are now seeing a significant wave of cases after having very few back in May. And sadly, India's total caseload just passed 5 million, and U.S. coronavirus deaths reached over 200,000, more than any other developed country. Vaccines are in phase 3 trials by a variety of companies globally, but we'll have to wait and see if any of those pass and ultimately get manufactured and distributed next year. Lastly, we have seen economic data surprise on the upside in the summer months. Perhaps this was to be expected coming out of an economic shutdown and on the heels of some of the largest coordinated monetary and fiscal stimulus the globe has ever seen. As we enter the fourth quarter, there's always room for disappointment, right? High-frequency data has already shown some signs of weakness, but maybe that's the bond manager and me talking, glass half empty. Maybe we should just buy the dip. I'll leave that decision to the Robinhood day traders. They're the hedge fund tycoons of the future. Look out, Bill Ackman and Stevie Cohen. Our first 2 episodes of Channel 11 focus more on the here and now. We discussed broader macro markets in July with Deputy CIO Jeff Sherman, and dissected the corporate credit markets in August with portfolio manager Robert Cohen. While us institutional portfolio managers face the pressures of near-term performance, investing for most investors, especially individuals, is really about the long term. Here today, my colleague Stephen Wald, who I work with closely at DoubleLine, will join me in interviewing the first outside guest to our show. I'm excited to introduce Todd Morgan, co-founder and chairman of Bel Air Advisers, one of Los Angeles' oldest and most successful RIAs. Todd and his firm have been very successful helping their clients invest towards their long-term goals. Welcome to the show, Todd. Todd, thanks for joining us on our show today. It's a pleasure to have you. And we'd love to hear a little bit more about what Bel Air Advisers does for our viewers right now.
My pleasure. Thank you for inviting us on, Ken and Stephen. Thank you. We're in the wealth management business. We manage money for wealthy families. And we don't have a lot of wealthy families. We have a little over 300 of them, but we manage approximately $8 billion for these people. And we're in not to make them rich business, we're in to keep them rich business. And we do this by strategic asset allocations among many different asset classes, whether it be cash, whether it be bonds, real estate, equities, emerging markets, developed markets, US markets, so on and so forth. And we have like 40 different strategies. And what we do is we try to tailor make a portfolio for each client's needs. And each client is a different sleep well quotient. And part of it could be that they have a different age, they have a different lifespan ahead of them. So we have to tailor make these for each person to make it unique and special.
How did you ultimately get started in this business?
I got started in this business by, I started reading Fortune magazine when I was about 16, 17 years old. And when I went to college, I was underage, but I opened up a brokerage account in my mother's name and I traded stocks in the stock market in between classes. And I got the money to invest by, I chartered airplanes, DC-3s or Electras, to send students during spring break down to Fort Lauderdale and Nassau. So the float, I invested in the market, and I was lucky. It was a bull market, and I made money for myself, and I became addicted. I was enrolled to go to law school, but I dropped out at the last minute to come into the business at a young age. So I was at 22 years old.
Yeah, look, we're in a tough market environment these days. Stocks are, I guess they're off their highs, but they're very high levels. There's a lot of uncertainty out there with the election. Bond yields are at historic lows. So what's the approach that you take to managing clients' money today? And is that different from, let's say, 10, 15, 20 years ago?
Yes and no, but I'll start out with no. When I started in the business, the Dow Jones was traded between 500 and 1,000 for like 5 years in the 70s. Now we're at what, 26,000? So the trajectory was always to the right and north on the charts. Prices kept going up. And, you didn't have to be a genius to make money in the stock market. Just buy the Standard & Poor's 500, hold it for 10, 11 years, you doubled your money every 10, 11 years. But with the question that you're asking is that are we headed into another problematic area? And I call this time of year hurricane season, because traditionally we have good sized market corrections September and October almost every year. And it feels like we've got one coming again. And I think the excuse for this correction will be the election and the COVID. But we did a chart at one time that shows 84 reasons why you should not invest in the stock market, starting in 1935. The Great Depression, bombing of Pearl Harbor, World War II, Korean War, assassination of a president. There's something every year why you should not invest in the stock market. And this year we know it's COVID, and it could be the election coming up. But if you put $1 million in to the stock market in 1935, today it would be worth close to $8 billion. $8 billion. And that's the magic of compounding. I think the number is like 7-8% a year compounding. So the key is you don't have to pick the exact right stocks each time. You have to buy, for example, if you just bought the index, the S&P 500, you will make money over long periods of time. It's impossible to time the market. Believe me, I've tried a number of times. I can't do it. The key is to buy quality and stay invested long term. So that's the moral. I tell people that, let's see, the market is at 26,000 today. I tell them, I think by the time I leave the planet, it could be at 60,000. My children, it could be 100,000, 120,000, the Dow Jones. And people always say, the market's dead. This is the end of it. Life's going to be different. It's just going to be different companies to invest in. What's very unique about this is I think it's going to change once again the kind of companies people invest in. I think many of our lives are changing dramatically. So it might not be so interesting to own, I'm just picking a name, International Paper, or some of the mining stocks. What's interesting to own is how it's changed our life, how we live at home, how we're going to spend more time at home. Technology. And that's where the real growth is, and that's where we've been putting more focus for our clients' money.
Yeah, it's interesting you say that. As I was driving to the office, I was listening to CNBC, and the talking heads were chattering about, I own this energy company, I own that energy company, and energy used to be a big deal. It was a large part of the S&P, over 15% of the S&P pre-crisis. Now it's only 3% of the S&P. It's just not as important to us. And clearly all these technology stocks have gone on the moon. Around when you got into the business, interest rates were very high, right? 10-year treasury yields, I think the high was September 30th, 1981. And I don't know if people thought rates were low or high then. To me, that sounds really high. I wish I could buy a treasury bond at 15% yield. And here we are at almost 50 basis points yield these days. We've been trading around kind of 50 to 80 basis points. Bonds historically were a safe haven. I guess they are still working a little bit for you in that regards, but they clearly didn't have the same safety they did in the global financial crisis, just because we started at a lower base. So there's just not as much room for rates to fall. So do you still think there's a place in investors' portfolios, retail portfolios for fixed income? Or is cash kind of the new bond as far as where the safety is?
Well, for wealthy individuals, I think you've come to an end of a 35-year bull market in the bond market, right? You've gone from like 18% down to, you said, 50 basis points. You can't go much lower unless we go negative, but I don't think we're going to go negative. So people, our clients are most interested in preservation of capital and getting the greatest return after tax and after inflation that they can without taking a lot of risk. So people are still parking their money in very short-term bonds and cash, waiting for higher yields. And I think we've gone from one end of the spectrum from 1981 to the other end. And I think it will revert back to the mean over the coming years. I don't think it's going to happen short term. You guys are the expert on that. But people buy these bonds for sleep well, for a safe haven. And they want to know that their money is there in case there's a major disaster. And I think that's why part of our portfolios, I'd say 30 to 40% of our portfolios are in fixed income or bonds. The returns have been 2-3%, sometimes 4%, but it's not a great deal, but people feel comfortable having that in these very uncertain times.
Sure, and look, it's been working this last couple of weeks. The equities are off, and bonds finally, at least for now, and there's no panic. It seems people are sleeping at night. So us as bond managers, that makes us happy. But we do like some periods of volatility, so we can buy some cheaper assets out there.
There will always be a place, Ken, for bonds in our portfolio.
Well, we appreciate that.
Looking at alternatives, so obviously you have your standard equity, your standard fixed income exposure. Obviously, COVID has brought about a lot of interest in alternatives. A lot of people raising money in private debt, private equity, some distressed real estate. Do you think these types of investments are attractive and worth kind of longer lockups and higher fees they generally charge? Have you guys done any major moves recently? Or do you still think we're kind of in the third inning of this type of environment and you have time on your side?
Well, that's a very good question. It's a complicated answer. You covered the waterfront between private equity, and we get private debt and real estate and all these things. This COVID has done damage to a number of these different areas, and it's like you're swimming and the tide goes out. You see who's wearing swimming trunks. We don't know how bad it is or how long it's going to last. For probably a number of months, probably not till next year. We have been very careful of adding any new money to these alternatives because of this uncertainty. And they do charge a lot, and you got a double fee, you got a fee plus profit participation. We are still attracted to certain types of real estate investments, multifamily types, for example. We like that area. Where we have a greater idea of certainty that people will remain interested in multifamily housing, which I think is very important. But we're very careful. And as you guys know, there's probably around, 600 billion, something like that, of money waiting to put money to work in these private equity deals. There's a lot of money chasing a few deals. It makes me a little bit uncomfortable. So
Sure.
We're cautious.
Yeah, there's been historic amounts of money raised in private equity. It seemed like every week one of the big players is breaking the record, 15 billion here, 20 billion there. Makes us sometimes a little jealous, frankly. We talked a little bit on the phone the other day about SPACs. SPACs are a hot topic. I like talking about SPACs. There's a book out there. It's called The Crash in 1929. It talks about the famous stock market crash. Talks about Goldman Sachs. That's where you started your career. And Goldman wasn't the only firm doing this, but there was these companies that were being raised called investment companies. And it was basically money being raised, not knowing what they would buy. And people were lining up to buy these things just as they did the SPACs. In fact, they would start trading higher in price and they didn't even own anything. And they'd buy other SPACs or other investment companies at that point in time. Needless to say, it didn't really end well. And that led to a lot of things like the 40 Act that eventually came out, which changed the way mutual funds and money management firms manage assets. When I read that book and I started hearing about SPACs, it made me think that they're very similar. So I know there's been some that have been successful. I'm sure there's a place and time for it, but it's such a hot topic. CNBC can't stop talking about it. So I'd love to hear kind of your thoughts about it. And maybe some stories of what Goldman thought back in the day.
Well, when I started at Goldman, I was there 20 years. That was one of the first things we learned in their classes, where it's about what happened in 1929, and they'll never let that happen again. It was a big embarrassment to them, and it took them years to recover. It makes me a little bit uneasy that people are putting money into SPACs without even knowing where the money is going or what they're investing in, and they're going to a premium. It's an illustration of so much money around looking for a place to go to invest, and people hungry for returns. And I think it could be problematic. The difference between now and 1929 was the leverage, and people were using tremendous leverage back then. And you will recall from your book, sometimes you only had to put up 10% equity. You could buy these SPACs with 10% down. So you got taken out very fast. But I'm not wild about fads. I'm kind of old fashioned. I like buying great companies, great bonds, et cetera, for reasonable returns. And we're in a business, we're in the singles and double business, not the home run business. And SPACs maybe are looking somewhat towards that. I have an old adage that I learned from a gentleman I met 40 years ago, was that the market will do whatever it has to do to prove the most people wrong.
Sure.
So if you think about that and what we've seen in our careers, when everybody gets bullish, it's time to get the other way. And everybody gets bearish and frightened like they were in March, it's time to buy.
Yeah,
sure.
easier said than done,
Yeah.
right?
Well, emotions have taken a big part. But my business, a little bit easier, is that if we tell people you're not investing for next month or the month after, the market is projecting what's going to happen in 6 months to a year. And our goal is to own companies. Some people say you own them forever. You don't want to own Eastman Kodak forever. You don't want to own names like that because they don't exist anymore, and Zenith and things like that. But you want to own things for 5 years, 10 years, and not pay taxes on it, which I know is one of your questions coming up. We got to be sensitive to the new tax possibilities that are coming. But we're trying to be long-term investors. It's easier to do during these uncertain times. And these SPACs, as you brought up, might be a red flag.
Yeah, well, there is an election coming, and one of the hot topics is definitely taxes. If corporate taxes are going higher, if capital gains taxes are going higher, if state taxes are going higher here in California, we're already at the higher end. Jersey just raised their state tax, so it's a big deal. I mean, that's why a lot of retail investors go in the municipal bond market that yields nothing today. And so, what do you think about tax planning? It seems to be even a more critical part of personal investing these days, especially as it comes to wealth transfer.
Absolutely. So that's a two-part question. Let me start out by saying the following. It looks like no matter who gets in the office, the taxes are going to have to go higher, especially on the state level, like for the state of California where we live, and probably New York. So I think that's a reality coming up. Number two, if the Democrats get in, we all know that they want to raise capital gains taxes, want to raise corporate taxes, and so on and so forth. It will be impactful for wealthy individuals. I don't think it's going to happen the first 6 months of next year. It might not even happen next year. It's a tough thing to do during these very uncertain times and being in a recession. You don't want to strangle corporations by moving their taxes up from 21 to 28 or 29% and causing earnings downfalls and cratering the stock market on top of 25 million unemployed. So I think it's going to happen, but I think it's going to be over a period of time. The other question is, what do you do if the Democrats get in and that you can forecast that they will rise? And what I think is people, we have to go through portfolios and decide, are you better off paying your taxes now, taking your profits, depending on what appears to be the future, and reinvesting and looking at it again. It seems like if you look back on a historical level, that after the period of rising taxes for investors, prices go down, but then they rise after. And people get back in and invest once more. It's too early to tell, but there's a lot of planning. The other issue to plan on is your estate planning. And I think this is one that really needs to be closely addressed. You know, right now we have a very favorable numbers to pass money on to the next generation. It's over $11 million per person you can pass on or give to someone else without a tax. There's talk that it could drop to 3 million. I think you'll see a huge early transfer of wealth to family and friends if it looks like that's going to be taken away. You know, it's an interesting period of time, which I've never lived through, but it seems like there's anti-wealth going on, and there's been the biggest disparity between the haves and the have-nots, and it's a big part of the campaign that's going forward right now by taking care of the have-nots and taking away from the rich. And they're not only just looking at billionaires, they're looking at many different wealthy people. So it's something to look at. We believe that there's a $68 trillion of monies and assets that will be transferred to the next generation in the next 20 or 30 years. It's unprecedented. And what we're focusing on right now is educating that next generation. So we've started a next generation MBA program that's going to happen every couple of weeks, where we invite our clients and their children and their grandchildren to learn more about asset allocation, what are municipal bonds, the importance of owning bonds, importance of owning stocks, et cetera, et cetera, et cetera. Because these people, I don't think, are prepared. we've never seen anything like this. But so that's the second part of your question. I think it's going to be a challenging time, what to do with all this money that's being passed on. And the question is, how do you pass it down with as little estate tax as you possibly can? And it could be changing dramatically by the end of next year. So we have to take a careful look at it. We have our own in-house estates and trust attorney that we have meet with our clients, and we don't charge our clients anything for this, to help them plan ahead to be set up properly to pay the least amount of tax going forward for their families.
Yeah, both Steve and I have 3 kids. Steve's got 1, maybe another one coming. I don't know. He hasn't told me yet.
No, Ken.
But that's definitely top of mind is, how do you pass it along to kids? But on that point, every generation seems to be affected by kind of their experiences, and it changes the way they invest. I got into this business right before the global financial crisis. I remember my bonus vested in February, and the market fell like 15 to 20%, pretty quickly in 2007. It recovered, but it kind of scarred me. And then I went into the global financial crisis. So I just have a little bit more risk-averse stance in the way that I look at the world and think about the world. And I think older generations, having gone through world wars and things like that, or the other periods of volatility, they have a little bit more bias towards taking less risk. And do you see that the next generation is more aggressive? They all want to bet on the next Snapchat or bet on the next snowflake or whatever the hot stock of the day is, and you're kind of seeing a little bit of that with the whole Robinhood trader thing going on out there. Do you notice higher risk appetite from kind of that next generation, or maybe they're even more scarred because they saw the global financial crisis. Now they saw what happened in March. Interesting, because I don't have too much interaction with that cohort as far as their investing behavior. So I'm interested to see if you guys have noticed anything on that front.
That's a good question. Yes, we have. Many of us have muscle memory of 08, 09. The stocks dropped at the low 55%. And there was tremendous fear because it looked like Wall Street was collapsing, and what's going to happen to your money, and is your money going to go down the drain when Lehman Brothers collapsed? Are you going to get your money back? So all those things left some scars on many people in the investment world. And it was reinforced recently by this COVID. And, it was an interesting statistic, but someone wrote that a third of the people over 65 years old sold their portfolios out in March and April. A third.
Wow. Yeah.
So that's pretty impactful. And by the way, that group getting slowly back in is, I think, part of the reason the market's gone higher. Now, I'll address your second question, these millennials. Many millennials are stuck home, and they like action, and they can't go to Vegas, and they can't go, they have been...
And there was no sports for a while. There's
no sports watching, no sports betting for the most part. So what are you going to do? They became experts in the area of trading stocks, and it became a game. So even if they've got several, $1,000, it's something for them to do, and they chase the names they know. Apple, Amazon, the things they use day to day. So there's been a flooding to those stocks, and that's why they become 5 FANGs become like 25% of the S&P. And I think they had a lot to do with it. Besides the institutional outlook that was, here's one of the few areas that we have visibility for growth going forward. By the way, I don't think it's a huge group of millennials that are taking big risk, but there's a group of people that are trading continuously, that are fearless, that continue to make these things go higher. I have found people in general, with a majority of their money, are still very conservative. Because of 08, 09, COVID, people don't come in and say, can you double my money in the next couple of years? If they do, I tell them to go to a different floor in the building that's got, a large hedge fund that is going to take more risk for them, because we don't do that. I think the biggest things to overcome, guys, is that fear and greed. It's an old statement, but I've learned to add to my clients' portfolios when my stomach hurts. Tape's running late, stocks are dropping at an unprecedented rate, and I get all kinds of calls into the evening where people are saying, should I get out? That's probably the time to get in. And when housewives start outperforming us, which they did in 1999, they were buying these stocks at 100 times or no earnings, calling me up and say, Todd, you're too old. And I was 20 years younger. You're too old to be investing in tech. You don't understand it. I'm going to move a few $1,000,000 up north to Silicon Valley. And they moved money up there. And a year or two later, 50% of the money moved back. So, you're starting to get a little bit of that now. I've got a trainer. My trainer's asking me what stocks to pick. Bernard Baruch said that he got out of the market because a shoeshine boy in 1929 asked him what the favorite stocks were. Remember, but there was 90% leverage back then. But everybody's investing in the market because they're looking for more ways to make money because you can't get money from your savings account or a lot from the bond accounts. They don't use DoubleLine to make their investments in the fixed income area. So it's getting a little bit frothy, and I think these kinds of corrections that are happening right now are important. I think that people need to remember that you buy great companies, you close your eyes, you don't let short-term gyrations interrupt the companies that you own, and you stay the course.
Looking at long-term trends, so kind of just looking forward a little bit. A lot of conversation. Every company seems to have a different view in terms of working from home and how that looks over the future. Jamie Dimon, I think, was in the market saying it's bad for junior employees. You have some tech firms saying they view them maybe being 100% virtual going forward. How do you think that trend plays out over the long term?
Well, I think it's got pluses and minuses. I think Jamie Dimon's right. I think our young people here miss the opportunity of mentoring and being in the office and the camaraderie of sharing ideas and gang tackling problems together on a immediate time issue. It's problematic. I work at home most of the time. I'm in the office today, but I don't have a secretary. I don't have a receptionist. I don't have an analyst. I got to call everybody up, and I'm trying to pick up 2-3 phones at a time. I miss being in the office, but I think a lot of people and some of our employees like working at home and will ask to stay at home. I think many people are going to want to stay at home, especially those in New York and Los Angeles have big commutes. And I know that Google and I think it's Amazon told their employees you don't have to come back until next summer. Most of them, you can work at home. So it's a challenging question. I want to hire more young people, but they're not going to get the same education by staying at home without seeing people in action, see people trade, see people pick ideas, going to investment meetings and watching people's faces and behaviors. I think it's going to be a slower educational process for many millennials that want to come into our business and other businesses.
Yeah, I mean, just personally speaking, I miss coming to the office. I wouldn't mind not coming in a day or two. I live far away. I'm in Palos Verdes, which is probably the furthest commute in Los Angeles. But I agree. You need people in together to talk about ideas. I want to touch on one thing. Going back to the investment world, we talked a lot about the tech stocks and growth and things like that. We're boring bond guys. We like buying stuff at discounts, you know. So it seems also people that have been around long in the equity market seem to have a bias towards value investing. Value investing has not been hot for a long time. Growth has outperformed value going back to 1999 now. And you know, if actual growth picks up, you know, things like value stocks and maybe commodities, which is also something else that people have been trying to call the bottom in. How do you feel about value and commodities, especially if we actually get some growth back in the economy with all the stimulus out there? We actually see some inflation coming in.
Well, the number of the value companies will possibly over the near term outperform growth once people are let loose and the vaccine works. But we've overweighted growth because we think there's a major change that's going on. We own a little bit of value, but not a lot, thank goodness. We own very little commodities. We have some clients that own a little bit of gold for diversification. But we primarily own great companies that we think will grow at a meaningful return over the foreseeable future. And that's changed a lot. You know, what were what were growth stocks before, some of them become value stocks because they've been hurt in this environment. And I think you have to review what a attractive portfolio looks like. And I personally believe that the investment world has changed somewhat, probably for the next year or two, as people continue to work more at home, travel less, go to hotels less, change their eating habits. I think there's a lot of changes here that are going to be longer term than people think, and some are going to be permanent. I don't think it's a time to try to put overweight value, even though people make arguments that value companies are selling at the biggest discounts they've sold at versus growth in history. And the price earnings multiples are half of what a lot of these growth stocks are going. But what's the growth rate going to be? What is it going to look like in 2 years? Sure. Have people really changed their habits? So you got to ask yourself those honest questions. And, you know, it's sometimes best to buy the best of something than buy something that's the worst and hoping it's going to turn around. Sure. It's interesting to note what Warren Buffett did. Here's a guy that was never going to buy a technology company, likes buying old companies he thinks will be around for a lifetime. And now his biggest position is Apple.
Well, he sold a bunch of banks.
Yeah.
And he sold a bunch of banks, and he owned a bunch of airlines that he sold.
Finally out of the
sold a bunch of banks, yeah. So, you know, nothing's forever. You have to be open. I'm not a trader, and I don't recommend people getting in and out of the market on a regular basis. But there's definitely been a change that's happened. There's definitely been a change, and you need good advice here. And it's important that you have an advisor that's up on the times, is opportunistic in picking the right kind of companies to invest in, and most importantly, put you in the right asset allocation going forward. Because that's, you know, as you guys know, it's 80-90% of investing, having the proper asset allocation.
So looking forward, both short-term and long-term, kind of given your experience in this business, what is the best advice you would give people in terms of investing their portfolios today and then say 10, 20 years down the road? Like, what are the main pitfalls you see your average investor fall into that you're hopefully able to talk them out of when you're dealing with some of their calls on a daily basis?
Other than selling in March.
Yeah, the world's ending.
Yeah. Try to look at yourself inside and make sure you understand what fear and greed are, and try to keep out of that. Number 2 is try to think longer term. Remember that every 10, 11 years, if you just bought the S&P 500, you double your money, going back for decades. Try to stay with quality and try not to get involved with fads, getting in and out of hot issues. That short term might be fun and okay, but it's not going to help your long-term portfolio. But I think stay the course. Set up an asset allocation that you will not be frightened out of, that you won't get too greedy about, and stick with that asset allocation. Does that make sense, Stephen?
Yeah, that's
no question.
Makes a lot of sense. What's your favorite part of working from home right now?
I don't have to drive to work, so I save about 25 minutes. I still get up about 4:30, and I go through my emails. But what I've done recently is that I take my dog for a walk at about 5:30, 6 o'clock for an hour, and I'm on the phone talking to the East Coast or talking to my people that are up that early. So I'm getting my work done while I'm having some kind of a workout during the morning. I like that. I also have my breakfast delivered to my desk every morning at a very early hour. I sit down about 5:30 after I come back from my walk, 6:30, ready for the market to open, and I get my lunch delivered. That's one of the things I miss most, by the way, is going out for lunch, because I think you really need a break. I think I enjoy working in my office more than I do at home. And I can tell you my wife likes me out of the house too. She can't stand listening to me all day long, talk to people. She gets, she's very, what's the right word? She's an empath. So she picks up everything. So she can't hear it all the time. But I think the biggest advantage is not doing the commute, having everything right there, and the disadvantages outweigh the advantages for someone in our business.
Yeah. we, food is a hot topic. We talk about it all the time. Steve and I and some of our colleagues have a text thread because the restaurants aren't open or we're not going out as much. So everyone has kind of their go-to favorite meal they're eating at home these days. What's yours?
Well, steak night, is it? What are you looking forward to?
In the mornings, I usually have a couple eggs and a piece of toast with peanut butter and jelly. That's my routine. Today, I ate a little bit light because I had a big dinner. I had a shake, a protein shake.
But what is there like a night of the week where it's like pizza night that you're looking forward to, or?
There's not enough of those nights, but my wife cooks for me Friday and Saturday night and Sunday. She cooks all weekend. She loves to cook. So I always get the most delicious meal. It's usually a surprise meal. That's my best meal. Last night we ate outside at a place called Ivy at the Shore. You guys probably are aware of it. They've got a little outside.
Long-time LA spot.
Yeah.
The food was magnificent. I was so happy. We went at 5:30, so we were the only ones there for about a half hour.
It's my favorite time to go to.
Right? Because we get up so early. But look, we're blessed and fortunate people. We're in businesses that we really enjoy, that we get up every morning and are enthusiastic. There are people that are more handicapped and don't live the life we live right now, and we have a job. So I'm in gratitude every day for the life we have and the lifestyle we have. And we've got terrific clients. You know, the great thing about my business is, being in the wealth management business, is that a lot of our clients turn into be friends. And it's a highly fascinating, the intellectual intercourse all day long, talking about many, many topics, is exciting and fun. So people say, why don't you retire? And I'd say, what am I going to do? This is my golf. This is my tennis. This is my chess. It's fun every day, almost every day. We've had some days in March that weren't so much fun, but we're all in a great business, and it's fun being in the service of others and doing a good job.
Well said. Well, Todd, thank you so much for making time to join with us. It's been a pleasure. Hope to see you in person one day, and have a wonderful rest of the week.
Yeah, really appreciate it, Todd. Thanks for the time.
Thank you for including us. I wish you all the very best.
All right.
Be well. Take care. Thank you so much.
Take care. Thanks, everyone, for joining us on Channel 11 News. We'll see you next time.